Good morning, everybody, and welcome to another Virtual Investment Summit by Fund Society. Today, we're going to talk with the Schroders about the commodities and the difference between the super cycle that we're living now compared with the one that we witnessed between 1991 and 1999 and 2008. So before I introduce you to my first guest, I want to remind everybody that you can send us questions anytime during the event. You can do it through the Q&A section of the WebEx app, or you can just send us an email to info@fundsociety.com. You can send us either in English or in Spanish. So today I have here with me at the studio Gonzalo Binello, Head of Latin America at Schroders. Good morning, Gonzalo.
Hi, Elena, how are you?
Good, the floor is yours.
So thank you very much. So, welcome everyone. Thank you very much for dialing in. We are gonna, as Elena mentioned, we are gonna speak about if this new commodity cycle is the same as the previous one. Clearly, there are some differences between this one and the one that we had between the end of the 90s and 2008. So with me, I have Malcolm Melville. He's the portfolio manager of our Schroders Commodity Fund. Basically, the fund is a well-known fund among our clients. It's an active management strategy, and we have been in the market for around 15 years. So welcome, Malcolm. How are you? Everything is okay there?
Yeah, good morning, Gonzalo. It's great to be here. Thanks very much for this opportunity to talk about commodities. Very exciting times in these markets.
Yeah. I've seen that you have a great weather in London. You're pretty well tanned.
Yes, it's been nice, and and we always try and get away a bit in August, try and catch up on those holidays we all missed last year.
Okay, great. So let's go to the point of interest. So commodities. Basically, we have seen that commodities has outperformed the MSCI equity index around 6%, during this first half of the year. This happened only once since 2008. This is new for us, since 2008. Is this a one-off, or this is a start of a trend? How do you see that?
Yeah, it's really interesting, the time in commodity markets. For us, I really believe that this is the start of a long-term cycle up in commodity markets, where commodities can be the asset class and can outperform other asset classes. If we look at this chart, what we can see here is the blue line depicts the relative performance of the Bloomberg Commodity Index, so broad measure of commodities, against the S&P. And you can see commodities tend to move in long-term cycles. So the last commodity bull market was from 2001 to 2010, and that peaked when oil got above $140 a barrel. And then we've had a long decade of underperformance of commodities. And this is really attributed in our mind because post the financial crisis, a lot of the attention of central banks was on saving the financial system. But we believe now we're at a turning point, we're at an inflection point where commodities, which have started to outperform other assets, can continue to do so over the coming years. And there is some similarities between the point now and the start of the previous cycle. And there's three I'd really like to highlight. The first one is that most commodity cycles follow a period of underinvestment in capacity. So what you have is a period of low prices or a period of very volatile prices, and that undermines the confidence and the ability of producers to invest in future supply. And the lead time for investment in commodities is very long, and that's why we have these long cycles. So we've had commodity prices which have been low for a period, and as a result, we don't have the investment in future capacity. So in many commodities, as we look forward, we see supply as being constrained. I think the second similarity is that we're probably going to have another capex boom. Now, the previous commodity cycle, 2001 to 2010, that was driven by a capex boom, but that was China orientated. We believe now it's going to be actually a climate mitigation capex boom, and many countries around the world are really focused on what they need to do to do that, and the fiscal spending behind that is going to be very powerful. So we have the underinvestment, we have a coming capex boom, And also, thirdly, I do believe that equity markets are somewhat overvalued. It's difficult to say and to be highly confident, but I think on a relative basis, as you can see for this chart, commodities are just getting started relative to equities. But there's also three key differences between now and the start of the last cycle. The first one is the focus on ESG and climate change and those policies, and that really has an impact on breaking the link between the demand for a commodity, it breaks the link between the increase in the price of that commodity and the ability for new supply to come on stream. The second main difference is we're a long way away from where we were in terms of the Washington Consensus. The Washington Consensus had 10 principles, but the three main ones were fiscal discipline, positive real rates, and trade liberalization. Now, we're a long way from that. We don't have fiscal discipline. It can be argued in many markets at the moment. We definitely don't have positive real rates in many markets. And also many countries are focused on stockpiling food, on food nationalism, and producing within their borders. So we're in a very different place on that side. And the third difference, which I think is really important, is the coordination now we have between fiscal and monetary policy. Where large fiscal deficits are by and large being financed or being helped to be financed by government printing. So, yeah, in a short, we think this is the start of a new commodity cycle, and I think it's a really interesting time to be getting in. It feels like a new beginning after a decade of poor performance.
So basically, you mentioned fiscal spending around 3 times between similarities and differences. So before, in 2008, we had a monetary stimulus, but a fiscal restriction in terms of spending. Am I right saying at this time we have both working together? And if that is so, how that is going to impact inflation? And if inflation will contribute to increases in prices of commodity, how that relationship is working?
Yeah, that's really interesting. I think that's exactly right. If you go back to post the financial crisis, we had fiscal policy after the financial crisis, which was immediately turned off. The governments were looking to tighten fiscal policy. We're not in that environment now. We do have that degree of coordination. So we have fiscal policy growing rapidly, and we have monetary policy being very loose. So both those two elements are working together. And the interesting thing and the important thing is both of them are focused on developing on the real economy and producing growth. But I think what is really interesting in that, so that's for me is the key, that coordination between the policies, and both of them, unlike post-financial crisis where it is focused on stabilizing the financial system, now it's focusing on growing the economies. And when you try and grow the economies, that's commodity intensive and tends to push up commodity prices.
So with that view, Fed tapering or restriction of the monetary policy might not have such a big impact as before on the commodity prices, because you have the fiscal kind of side working against.
Yeah, I think that's absolutely right. And if we can go to the next slide, I think where a lot of the fiscal policy is directed, that's great. A lot of the fiscal policy is directed is at climate mitigation strategies. And that is a key driver, we think, of commodity prices. And I mentioned to start with, one of the reasons commodity moves in long-term cycles is we have this period of underinvestment. So if you look at this chart on the left-hand side, this shows you long-term capex spending from key oil and gas companies. And you can see, if we cast our minds back to 2013, 2014, that was an amazing period. The oil price was averaging between 90, 95 and 105 for several years. And at the time, there was talk, people were saying, can oil prices stay at $100 forever? I mean, $100 forever is a very long time. And if you had have said then that in a decade time oil prices will be negative, it would have been hard to contemplate. But the world has moved on from then. And one of the reasons it's really moved on is shown in this chart, is because you see on the right-hand side, when we look at the capex spending plans for these many companies, a lot of these companies now, I would say the majority of energy companies, are very much focused on new energy sources, green spending. And what has that meant is that the price of oil has recovered in this post-COVID rally from the lows we saw in oil prices when they turned negative last year. The oil price is back up into the 70s. And for many companies, at $70 a barrel, that's very profitable for them to increase supply. But they can't increase the supply in the way they would have done in the previous cycles. And the reason is twofold. Firstly, shareholders are demanding higher dividends. After years and years of volatile oil prices and low dividends, oil companies are now paying out a lot of their hard-earned cash in dividends. So the average dividend on an oil ETF is in the region of 4%. If you go back to 2013, when oil was at 100, the average dividend was about 2%. And the second reason, which I think is the key really, is that all these companies want to spend any excess cash they have on capex in green new spending to diversify themselves away from fossil fuels. So investment in fossil fuel capacity is really being constrained. So I think it's possible to argue that ESG considerations is breaking that traditional link between an increase in price and a supply response. And that's why it's one of the reasons it makes commodities at the moment so exciting, because we have a new dynamic operating in the market, in the commodity markets at the moment.
So that's a very important point. So basically, in the previous cycles, we had an increase in price, and then, as you said, an increase in supply. So that was putting a cap on the prices of the commodity. Now, in this new cycle, what we are having is an increase of price, but not necessarily an increase of fossil fuel supply. So that means that we have a window, kind of period, or a gap between the prices increases and when the supply is going to be available in a different kind of commodity, or in a different kind of energy kind of supply. So how long would you estimate that this window in which prices will continue going up for fossil fuels is going to remain until we see new energy sources coming into the market?
Yeah, it's a really interesting question. People focus a lot about when is peak oil demand, and that is it's very difficult to tell, because it does tend on the pace of adoption of other technologies and other fuels. But what I would say is that even when you get past the peak in oil demand, which is probably several years away, middle of this decade, towards the end of the decade, quite possibly, the need for these fuels will still be there. It's very interesting at the moment in Europe. In the last few days, it has been very still in the weather, and the UK and Europe has invested huge amounts in new wind capacity. So a lot of our electricity generation comes from wind and solar. And the problem is, when it's not windy, that wind capacity isn't there, and you have to turn to alternative fuels to keep the lights on. So we've seen recently in the UK and in Europe gas-fired power stations being started up, and recently coal-fired power stations being started up. Now, no one wants to use coal-fired power stations to generate electricity because of the environmental considerations. But when you're in a world where a lot of the energy is coming from renewables, if you have a disruption to that renewable source, then you're forced to go back to the more traditional sources of energy. So even when you pass peak demand, and I'm sure we've passed peak demand in, say, coal, for example, where we've seen the rapid closure of coal-fired power stations globally, but particularly in the US, there is still demand there. So it is interesting, and I would say it's not just in the energy market where we're breaking this link between supply and increases in prices and supply. If you look at the aluminium market at the moment, the two key drivers of aluminium demand historically has been the Chinese property sector and the car manufacturing. That's two of the important demand drivers. And both of those have been weak for the last few months. If you look at the China credit data, that's been weak, and the Chinese property sector is weakening. And that's had an impact on aluminium demand. And then if you look at car production globally, because of some of the chip shortages, for example, car production has also been suffering. So two key sources of demand aren't there. And in a normal commodity cycle, when you lose those sources of demand, you would expect the price of that commodity to go down. But what we're seeing is aluminium prices at 10-year highs and continuing to go up. And that is because the supply is being cut quicker than you're losing demand. And the reason supply is being cut is because the supply of aluminium, to make aluminium, is incredibly energy intensive. And to meet environmental goals, that those energy that production of aluminium has been cut right back. So it's really interesting, that link between supply and price. You see it across a range of commodities is starting to break down.
That's a very interesting. Well, we had this year here in Texas a situation where the windmills, basically the wind generation got frozen, and people in Texas ran out of light because they didn't have another source of energy. So this goes to the next question. So the last cycle was mainly driven by Chinese infrastructure. So I remember in 2008, 2007, we were all talking about the Chinese kind of building their infrastructure and that driving commodity prices up. What are the drivers in this cycle?
Yeah, I think it's a great question, because a lot of people now are looking at the rollover in the Chinese credit growth and saying, okay, well, that means commodity prices should come down. And in past cycles, that's what would have happened. You would have seen China, which was a key consumer of many commodities, their demand was shrinking, and the end result would be that commodity prices would fall. But we think this cycle is slightly different, and it's shown here in this slide. On the left-hand side, you can see the total infrastructure spending as estimated in China from 2005 to 2020. It's about 25 trillion. It's difficult to be exact on the numbers, but roughly 25 trillion. Now, if you look on the right-hand side of that chart, you can see the climate emergency capex, which is expected from the OECD and Wood Mackenzie. They estimate that to be in the region of 95 trillion. Now, whether the climate emergency capex spending is 95 trillion, 80 trillion, 100 trillion, it's very difficult to say, because we're talking about capex over the next decade or so. But what is clear is that in relation to what we saw in the last commodity boom, the capex you can expect for to mitigate climate change considerations is going to be much, much bigger than what we saw in the last commodity cycle. So that's why I think the environmental considerations are very interesting in the commodity markets, because it has an effect of decreasing supply of some commodities, but at the same time, through the capex program, think about the move to electric vehicles, the charging points, the infrastructure, the solar, the wind. Some of that is very commodity intensive, and therefore you have that double whammy where supply is constrained, but demand at the same time as demand for these commodities is increasing. So it's really interesting in terms of the change. It's not going to be a China-driven commodity cycle. China will remain important, absolutely, but there's going to be other factors driving commodity prices, we believe, in this cycle.
And so basically, as far as I understand, basically is we are going to have in the short term, we are going to have a restriction in supply for the traditional commodities of producing, energy, where we might see oil prices going up because of restriction in terms of the supply. And not restriction in terms of supply, but an increase in the short-term demand as the world comes into traction again. After that, we are going to see an increase in those commodities related to climate change. So basically, different sources of energy production. So which are the commodities that you see are going to be mostly benefit out of this climate change new environment?
Yeah, I would say across the whole spectrum. In base metals, I would probably pick out aluminium because of the supply constraints we talked about, with a lot of the supply coming from Yunnan in China, and that really being disrupted at the moment because of the environmental considerations. So aluminium is there. In the longer term, nickel, because of the importance that has for batteries. On the energy side, natural gas shouldn't be forgotten. That's one of the cleanest forms of energy, and also can be used as a kind of a filler, a stopgap for when you have disruptions in your renewables. It's quick to use natural gas to generate electricity. So, and its natural gas is much cleaner as well than some of the traditional coal measures. And on the agricultural side, it's really interesting because there's a number of considerations. I would say on the agricultural side, you have the biofuels debate and about how much of the agricultural commodities, corn, should be used in the biofuel. But you also have climate change considerations having an impact on some of the other commodities, say coffee, sugar, where in Brazil, for example, it's been very, very dry for for this year, and that's having a significant impact on the amount of irrigation you can have for those crops. So those would probably be our highlights, but it has an impact across many different commodities.
So going to the next question, basically inflation. Let's dig a little bit into the inflation kind of trade-off. Inflation is picking up in several countries. We are seeing, inflation, data coming into the markets saying, everywhere that we see inflation is picking up. Will this continue? The Fed is saying this is temporary. What is your opinion about it? And how investors can protect, and hedge their portfolios about this inflation?
Yeah, inflation is a really interesting topic at the moment. When you're talking about inflation, I think it's important to understand what we mean when we talk about higher inflation. When we talk about higher inflation, and we do believe that we are going to move to an era of higher inflation, we're talking about moving from a regime where over the last decade, US inflation has averaged about 1.8%. So what we've seen in the last decade is US inflation rises to about 3, then corrects to about 1 or 2, 0 sometimes, then comes back to 3, but averages about 1.8%. US inflation at the moment is 5.4%. Now, some of the factors that have taken US inflation to that level may prove to be transitory, but it's our belief that what's going to happen is that US inflation is going to settle at a higher range. So we've got to 5%, maybe US inflation could come back to 3% in this trough, but from then it's probably like to increase again. So we can see inflation moving to a higher regime. You don't have to think inflation is going to sort of 8, 9, 10%, I think, to think the inflation regime is changing. It's just moving away from what we've all got used to, especially in developed markets, which is a period of very, very low inflation. And moving away from that regime of lower inflation is important. And when you move to a higher inflation environment, commodities tend to be the best performing asset. In a rising inflation environment, I would say a broad basket of commodities, as you can see on the right-hand side here. So in a rising inflation environment, stock markets do fine. They do okay. They deliver returns on average of 6.8%. Bonds do okay, actually, in a rising inflation environment. But it's commodities that do really well in that rising inflation environment. And that comes back to the chart we had at the very beginning, which was show the relative performance of equities versus commodities. In a rising inflation environment, if investors want to protect themselves against inflation, then commodities does provide a very good hedge, and commodities does tend to outperform other asset classes in that environment.
Okay, so basically there is a case for commodities in terms of rising inflation and hedging the portfolio, basically about new environmentally friendly sources of energy, about restriction in terms of supply, basically a short-term restriction in supply versus the increase in demand that we are going to see as the world comes into traction again. So now, what is the best way of playing commodities? You've been in this market for a very, very long time. So there is a lot of, basically since 2008 until now, we have seen a lot of passive investments options coming into the market. We have an active management strategy. What is, in your opinion, the benefits of having active management compared to a passive management strategy?
Yeah, it's the active versus passive management argument is fascinating. And in the commodity space, where I think there are a lot of inefficiencies, it's first necessary to look at what are your passive options to really understand that. So it's not just a simple question of picking a benchmark and following that, because different benchmarks give you very different exposure. So you have the Bloomberg Commodity Index, which is the index that the Schroders funds follow on the left-hand side, which is very much a 1/3 energy, 1/3 metals, 1/3 agriculture. But then you have the S&P GSCI, which a lot of funds and ETFs can follow, and that has a very high weighting to energy. 54% of those assets at the moment are in energy. And the end result of that is that it means the returns are very much more focused on that energy sector. So when we saw energy prices fall very rapidly last year, the GSCI index fell peak to trough over 50% because of that energy component. And then you have the Rogers index, which fits somewhere in between the two. And the other thing to think about when you're thinking about passive is, again, different strategies have different things. Some focus on the front month, some focus on liquidity, some focus on yield optimization. And I think the final point to make on the passive is they're not actually that passive. And by that I mean that we saw post when oil prices turned negative that many of the ETF providers, they changed their role strategy within their products. So although it's passive, someone is actually saying, okay, we don't want to hold that oil contract, we want to hold this oil contract. So in my mind, it's kind of more active than passive, because it's following a program until someone decides to change that program. So we at Schroders follow an active management approach, and the reason is it really gives you three key flexibilities, I think. The first one is you can pick and choose which commodity you want to have more exposure to at any one time. So as I say, our funds follow the Bloomberg Commodity Index, a very diverse benchmark, but we do analysis on individual commodities, and by doing individual commodity analysis and selection, I do believe that it's possible to identify those commodities that are going to do better and avoid those ones that aren't. Second advantage is that you can position along the curve. So the majority of commodity funds invest in commodity futures. A lot of those are invested in the front month, most liquid contract. But with active management, you can choose to pick which part of the curve. So for example, post at the height of the COVID sell-off in April and May last year, a lot of our oil exposure was focused on the very longer dated contracts. We didn't hold any of the shorter dated contracts because we thought there was a demand hit that would come, would have impacted oil prices. No way did we think oil prices were going negative, but we thought the front end of the curve was more susceptible to that demand shock than the long end of the curve. And that flexibility in that active managed product means you can pick the part of the curve when you're investing in commodity futures. And the final element is the ability to hold cash. And that gives you flexibility to preserve capital. One of the products we launched in Schroders, it must be 5 years ago now, is a commodity total return fund. And we launched that because there was a number of investors who wanted exposure to the commodity markets, but they didn't want the volatility, they didn't want the drawdown. And to do that, we launched a total return fund that aims to capture 2/3 of the upside, 1/3 of the downside. And in the deep sell-off in commodities last year, that fund managed to avoid a lot of the sell-off, and peak to trough was down about 10.5%, when some of the commodity indices were down between 30 and 50%. So I believe active management in commodity markets really does give you those flexibilities over that passive approach.
Well, within the active management universe, I usually get the question about what do you do with your cash, basically because you are buying futures. So what is basically the strategy that you have for your cash management?
Yeah, we take a very simple approach. I think there's two approaches with using the cash. One is to use the cash to invest in other instruments, other financial instruments. Some funds invest in other bonds to try and increase your total return. What we do is we invest in short-term T-bills. And the reason we do that is because our expertise and our focus of the analysis and the focus of the fund is investing in commodities. And therefore, we don't want to take unnecessary risks. You may get a few extra basis points by investing in some bonds rather than investing in US Treasuries. But that's not where our expertise is. So we really focus on the returns in the fund comes from investing in commodities. There's nothing worse than being invested in a product and you find that it loses money because it had exposure by the back door to another product. So we keep it very simple. Focus on the commodities, really do our analysis on those. And the other reason I would say is that commodity markets are very volatile. So if we do our analysis right, and if we're right, then the movement in those commodities should be enough to generate significant returns, generate good returns for our clients without having to take that additional risk of investing the cash in different instruments.
And how has the strategies performed during the last I would say 1 year and year to date?
So as I mentioned, the total return strategy The total return strategy aims to avoid the downside. So actually in 2020, the total return strategy was up close to 20%, 19.8%, and that's against a broad Bloomberg commodity index, which was down about 3%. And the reason that was we managed to avoid a lot of the downside and participate in the upside. So over the last 3 years, that fund has outperformed the Bloomberg commodity index in the region of 30%. We also have another key fund, which is very important to us, which is our benchmark aware strategy, and that aims to outperform the Bloomberg commodity index by 3% per year over the long term. And in the last year, that in 2020, that fund also outperformed the index by in the region of 6, 7, 8%, depending on the share class in the fund. But those two strategies are managed by the same team with the same investment process.
Oh, great. So going to the last question before opening questions to the clients. We are usually having headlines about the energy prices, the gold, and basically Dr. Copper. What about the ag sector? Do you see any good opportunities in agriculture or other metals besides aluminium?
Yeah, besides aluminium, yes. Let's stick with it. The agriculture is 1/3 of the Bloomberg Commodity Index. And as you say, it's a sector that's often overlooked. People focus on Dr. Copper as a leading indicator of where GDP might be going, or oil prices get their headlines. But actually, agriculture is really important. And this is where China is really still a key driver of agricultural prices going forward, because there has been a structural change in the way China looks at commodity prices. They're very much now focused on food security, and that's not just a China thing. We see that across the world. Many African countries, for example, are very focused on food security and are importing aggressively on wheat. But in China, I would highlight 3 key markets where China has moved to a structural deficit. One would be in the soybean market. Now, they've been in a deficit for soybeans for many years, but that deficit continues to grow. And when you look at the imports of soybeans into China, particularly from the US, that has grown very rapidly. So they really are importing huge quantities of soybeans. The second commodity to highlight for China, and then that's where there's been a really big change, is corn. If you look at the corn market from 1965 to, 2015, generally China had a surplus of corn. This is shown in the middle chart here. You can see the surplus deficit, those blue lines, they're generally above zero. And that shows that China had a surplus of corn. They imported a little bit, they didn't need to import too much. But the last 4 or 5 years, China has moved to a big deficit for corn. And the end result is that their imports have skyrocketed. And you see that in that middle chart with that green line, the imports. So China is becoming increasingly dependent on imports of soybeans, which they were before, on corn, which is again a key commodity, but also on smaller commodities as well, which get less focused, things like pork, lean hogs. You can see there's a growing deficit. So earlier I talked about this commodity cycle being different in terms of China not being a key driver from a capex perspective. But for agricultural commodities, China is really still very important, and actually it's a source of new demand that we haven't seen for many key agricultural commodities over the last few years.
Very interesting. So, okay, so with this we finished this section. Elena, do you want to move on with the questions?
Thank you, Malcolm. It was very interesting. Yeah, we're actually receiving several questions from the clients. We're going to start with this one. Could you please comment on possible near medium-term risk faced by Brazilian biodiesel companies?
Oh, I have to say my knowledge of the risk of Brazilian biodiesel companies is limited. So I'm not sure I can be very helpful on that. It's not a sector I cover widely. What I would say on the biodiesel sector is that the pressure, for me, the growth of the biodiesel sector is really a reflection of those considerations we talked about earlier from a climate change standpoint. And it's just that the rise of biodiesel and the importance of biodiesel within the energy mix is just another example of how climate change mitigation policies are having impact on commodity markets. So I'm afraid, sorry, I'm not an expert on those Brazilian companies, but the sector as a whole, in terms of the biodiesel and the impact that that can have on commodity prices, is clearly it's another one of those climate considerations that is front and center of policymakers.
Thank you. Another question. There seems to be a gap between oil and oil stocks. When do you think the gap will close, and why is this happening?
Yeah, that's really interesting. The gap between oil and oil stocks, and for a lot of investors, that's been difficult to understand, because you have oil prices which have recovered very strongly, and oil stocks that haven't performed that well. And I think it's a long-term structural issue here. There are many investors now who find they are not allowed, they're restricted by their mandates of investing in traditional fossil fuel oil companies, and therefore the capital available to those companies and the ability for investors to invest in those companies has shrunk dramatically. You've seen the Norwegians, for example, moving away from that sector completely. So I would put it down, the rationale for that, as the climate change considerations. Investors don't want to hold those sort of companies, and therefore, even though the profitability of those companies is going up, even though the dividends they're paying, as I mentioned earlier, is going up, and they're under pressure to return capital to shareholders, it's very difficult for many investors to invest in that sector, given the changing mandates of clients. So it's difficult to see that divergence. I'm sure at some stage, if oil prices do very well and get up to 100, oil stocks will respond. But will oil stocks reflect the same amount of value of the oil prices they did before? I'm not so sure, given those restrictions we have on investors' ability to access that sector now.
And what about the dollar? Are you expecting a weaker dollar for longer? What is the rationale backing this scenario on how it can be beneficial for commodities?
Yeah, the dollar, we are in the camp that the dollar should be heading lower. It's been a long process, but if you look at the long-term cycles of the dollar has been rising pretty much for the last decade or so, and there are signs that's starting to change. And I think the key long-term driver for the dollar really will be the twin deficits. So when we talk about the twin deficits, we're talking about the current account deficit plus the fiscal deficit. Now, the counter argument people say is that, well, everyone's got fiscal deficits, so what's the problem? It's just a battle of who's got the bigger fiscal deficit. But the difference is that the US started the COVID crisis with a fiscal deficit and a current account deficit. So unlike in Europe, for example, where they had a very healthy current account surplus, which somewhat offsets that fiscal deficit. So in the longer term, I do believe the value of the dollar will go down, and that should be supportive for commodity prices. There's a very strong correlation between a weak dollar and inflation as well. It's a weak dollar is generally inflationary, and the commodity prices.
Also, we have a client asking about your outlook for gold and precious metals in general.
Yeah, gold. So gold has been an asset that investors have really fallen out of love with for the last year or so. And partly for that, the reason for that is that many investors are looking towards central banks, particularly the Fed, and expecting tapering. The Fed is printing $120 billion a month, and they're expected to wind back from that. And they think the process of tapering is going to lead to Fed eventually rate rises. And the extreme negative real rates we have in the US, about negative 1% on the 10-year, those negative real rates is the theory behind the gold bears. Those real rates will increase back towards zero, and that normally would be a bearish environment for gold. I have to say we're in a slightly different camp. I talked earlier about how inflation might be moving to a newer, higher regime, and I think in that higher regime, where you have that coordinated fiscal and monetary policy, I think we could be in for a regime of of deeply negative real rates for a longer period of time. So can real rates go to minus 150? Central banks have said, ECB and the Fed, two in particular, have said that they really want inflation to be higher than it was in the past. So in my mind, that is an environment where you have real rates can stay deeply negative for a long period of time. So that should support gold. The other thing to mention is that both gold and silver are very out of favor. We do a lot of work looking at investor positioning, where investors invested at the moment, and the attitudes and positioning towards particularly silver is one of the lowest it's been for many years. So that in itself can be a supportive factor for those assets. But longer term, yeah, precious metals, we still think they have a role to play with deeply negative real rates.
I think we have time for another question. Do you have an estimate of the target price that could trigger the next super cycle in each of the commodities that are part of these Schroders portfolios?
I would say the super cycle has started already. With our analysis, we do have target prices for all our commodities. Myself and my colleagues specialize in different areas. It's difficult to say on an aggregate level because we're moving into a new environment. Can oil prices get back to 100 in the medium term as those supply restraints kick in? I think absolutely possible. I mean, commodity prices can do amazing things. Aluminium's already at 10-year highs. Copper's approaching all-time highs. Corn and soybeans recently have been at all-time highs. So as we move to this new environment where the traditional drivers of the commodity cycle move over and where the key drivers become the climate change consideration, the lack of supply, the increase in demand, I think that we can see commodity prices go to new all-time highs.
I have another, the last one. So for the as of the end of the second quarter of 2021, what will be your exposure compared to the benchmark? What is your view?
Yeah, so one of our key positions, I'll highlight a key position in each sector. So one of our key positions in the energy sector is overweight U.S. gas. We like US gas for a couple of reasons. I'll keep it brief, I'm conscious of time. But the first would be inventories are lower than normal at this time of year. Secondly, when you look at global gas prices, they've gone up very, very aggressively. And when I mean very aggressively, UK gas prices have gone up 13 times since May last year. They've gone from 10 pence a therm at the absolute low to 130. And European gas prices and Asian gas prices have also been very strong. So the pressure on US gas prices, the export channel of LNG, is there, as is the growing use of LNG domestically in the US. So within the energy sector, natural gas stands out as the key winner. Within the metal sector, it's aluminium. Well, I've talked about the reasons for that. And within the agricultural sector, I would say it's the soft commodities of coffee and sugar, where we see structural deficits in those markets, and where the Brazilian frosts and the significant drought we've had in Brazil for the last year is really crimping supply of those commodities. So that's a very much coffee and sugar is very much a supply-driven argument for liking those two commodities. So I'd say those would be the key commodities: natural gas, aluminium, coffee, and sugar.
Okay, well, thank you very much, Malcolm, for joining us today. We really appreciate it.
My pleasure.
And of course, thank you,
Thanks.
Gonzalo, for being here at the studio. Thank you, Schroders, for doing another super interesting event with Fund Society. And I will see you on the next Virtual Investment Summit. Thank you. Have a great day.